Hey everyone, Jeremy Portnoff here, back again for another video. Today I wanted to talk about the stock market during recessions. We're here in early August of 2022, and certainly the topic of recessions has come up quite a bit lately. We've had 2 quarters of negative GDP, which is kind of the common definition of a recession. And there seems to be some disagreement in the financial and political community about whether is this really a recession or not, because there's different factors. And so I just kind of wanted to talk about that because whether we are or are not in the recession, I think what most people in this context are concerned about is what's going to happen in the stock market, right? So just keeping it in that context, that's what I want to talk about today. Real quick here, disclaimer on the screen there. So go ahead and pause to read. All right, just remember it's important to know that how this information may apply to each person's individual situation may vary, so you should always consult with a qualified financial professional if to see how it impacts your situation. So, all right, so let's take a look here. So we're looking at a really long-term chart here of the S&P 500. Let me make this a little bit bigger. There we go. So this is actually going all the way back to the 1950s, and the gray bars are the recessions, the shaded areas of the recessions, as indicated by the National Bureau of Economic Research. And they're kind of the arbiter of recessions. They have their criteria and they decide when we're in a recession. Now, one of the things that's really, really interesting about a recession is that we usually don't know until we're well in it, right? And so once that announcement is made, sometimes we're already on the other side of it. So it's kind of an interesting dynamic. Now, what you can see here is that it looks like that we've got, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 recessions since the really the early 50s, right? And they last varying periods of time, as you can see. And so what we're going to do is just take a look at, well, what did the stock market do during that time? Now, I want to be real clear about a couple of things. Now, we're only looking at the context of what the market did during that shaded area. That means there could have been gains or losses that occurred before or after that shaded area. So when you talk about a typical bear market, for example, if it lined up with a recession, we are only looking at what happened during that recession. So I kind of set out to create this chart to see, well, what really has happened during these recessions. I kind of got some surprising results that I have to say I kind of wasn't expecting. And what we can see actually is there have been several, it's basically about half of the recessions where the stock market actually went up. But it's not just what did it do from the beginning to the end, but what happened during that time. So just kind of starting at this first one here, we are looking at approximately 1953 to 1954. And we can see that from the beginning of the recession to the end, the stock market actually went up about 17.5%. But it did have a drawdown initially of about 8.5%. So that one's not too bad. Let's just scroll here out to the next one. All right, so the next one we've got there is 1957 September to about April of 1958. This one was a negative return, only about 4%, not too bad. Again, to my previous comment, you can see actually the peak of that market movement would have happened here before the recession was indicated of starting. But again, we're just looking at that recession. So we've got about a 4% drawdown from start to finish, approximately. But we can see that during that time, from the start of the recession to the worst, was actually about a 14% loss. So that was a little bit more. Okay, moving on to the next one. So we've got 1960 in April to about February 1961. And again, we've got the stock market went up pretty good during that time, over 17%. We do see there was a little bit of a drawdown. And so for the first part of that recession, right, the market would have been down. Again, we're ignoring what happened before then. We're just looking at during that recession. And one of the themes I think you'll see is that during the recession, even to the times when the market went down, usually toward the end of it, the market started rising. I think that's going to be a really critical thing to remember because whether we're in a recession or not, whether it's going to continue, we wonder what's happening with the stock market, it begs the question, because the stock market is often a leading indicator, you tend to see the market recover before the recession is over. So that's kind of an interesting thing to keep in mind as we're looking at these. All right, scrolling on down to the next one. There we go. We've got about January 1970 to about December 1970, so about that full year. And you can see here, stock market being down about 6% during that recession. But obviously this one had a much bigger drawdown to the middle, right? But again, just to my prior comment there, that worst of it happened in the middle of the recession. In the second half of the recession, the market was coming back up. So this is kind of an interesting one. So the stock market did go down a fair amount during that particular recession. All right, moving along. All right, now we've got here, this is about December 1973 to about April 1975. And this one was a little rough, you can see. And again, we're ignoring what happened before and after, just the shaded period. You can see that the market was down almost 14% during that recession, but clearly the drawdown from the start of the recession to its worst part, market was down 35. And so we can obviously see that this entire movement would have been more than 35, but this would have been a time when a recession coincided with a really pretty bad drawdown in stocks. But again, you can see where it ended, and kind of that last third, the stock market was coming back up, and it actually continued going from there, as you can see as we continue to scroll. So that one's kind of interesting. Here we have another positive return during recession. So we're looking at 1980 versus into August of 1980. So actually a positive return, almost 6%. But again, there's that drawdown, right? About almost 15%. But again, we see it rising in the second half of that recession. Okay, this is the so-called double dip recession, right? Came in August of 81, about a year later, to December of 82. This one was also pretty rough. Now, again, very interesting to me, the return from the start of recession to the end of the recession, the stock market went up 5%. But during that time, toward the latter part of the recession, that market was going down for a while. And again, ignoring what happened before the shaded period, just from the beginning to the worst part of the market here, about a 22% drawdown. Again, same thing. Toward the end of it, you see the market coming up. So that one was a little bit rough there. Okay, and obviously, as you see as I'm scrolling through, we're ignoring periods where the stock market went down and there was no recession because, again, context of this video is to look at what did the market do during recessions, right? So here we got the next one here. This is 1990, August of 1990 to March of 91. Again, it's a positive return during this recession, right, by almost 6%. Again, but we got that drawdown there, right, almost 17% before coming back up. A while to get the next one, but there we go. 2001, which is about March 2001 to December 2001. Again, remember, we see that the stock market, which this was the tech bubble, peaked much earlier, and you can see the entire movement of that. That was obviously a very bad bear market, but again, just focusing on the recession part of it, the return during the recession was only a negative about 1%, not too bad. The drawdown, though, was closer to 16%. Again, you see where it ended before the end of the recession, before starting to recover. Again, in this case, it went down further after that recession. So that's kind of interesting. So we're going to fast forward here. We're going to get to the financial crisis, which this one was obviously pretty bad, right? Again, same thing. You see the peak of that market movement here to the bottom. Just going by the shaded area, we can see that the return of the stock market during this recession was about 36% loss. The maximum drawdown during that period of time being about 53%. So it was actually worse than that, right? If we measure from a little bit before then. But the point being, this recession coincided with a really terrible stock market decline. But as we've seen as we go through these, it's not always the case. There we've got the Corona crash. This one was obviously pretty quick. Oh, there we go. Zoom into that a little bit more. There we go. again, recession part of it, it was only down 6%. Obviously, the entire movement was pretty rough, and the decline from the start of the recession to the worst part for the market was down almost 26%. Again, we see it rebounding halfway through. So this is pretty interesting. We do see that during these recessions that, the market, from the period of the beginning of that recession to the end, in some cases the market has been actually up. Other cases it's down. In most of those cases we do see a drawdown, and in a lot of them the drawdown was pretty rough, but we would see it occurring during a time, the worst part of it would occur, but then we would see that rebound happening before the recession was even over. And so I think this is really interesting, because if we consider what we're looking at now, and so this is the present decline that we see here with that peak in January, and you can see where we are here in August. Obviously the trend of that market's been down. It has been rebounding lately. Now if we are in a recession, right, we don't see that labeled on this chart yet, because the National Bureau of Economic Research has not indicated that it is in fact recession. But let's just suppose that it is, that they're gonna name this as a recession. Again, we're not going to know until after the fact how much of this market decline is going to be shaded as being in recession. I mean, even if it's close to that peak there, we could say that, well, is this the bottom here? Was that June bottom the low? And is it starting to recover? That's the part we don't know yet. But I think this is really interesting in the context of this discussion, is that we tend to see the market bottom before the recession is over. Right? So I don't know what's going to happen here. Only time will tell. And perhaps I'll revisit this particular chart and this topic rather, after it's been determined whether we're in recession or not. But it's just something to keep in mind. Certainly for those who are fully invested and remain fully invested, this might be a possible bright spot to consider, that even though we might be in recession, it doesn't necessarily mean that the stock market's going to do bad. Or alternately, we can say the stock market already did bad. Maybe it's going to get better from here if it follows the previous pattern of other recessions. Again, because the stock market tends to be an early leading indicator, which means you're going to see the bottom of a stock market occur before the recession is over, because it starts recovering before everything else. So, interesting way to look at things. If you have any questions, feel free to reach out to me. There will be a link at the end of the video where you can click to call, or if you have a different advisor, certainly obviously contact them and ask how that relates to your individual situation. All right, thanks for listening.